Welcome to the Pro Ticker Deep Dive. Today we are jumping straight into a sector that, frankly, many, myself included, had pretty much written off. Biotech stocks. You sent over a fascinating stack of material detailing what looks like one of the most surprising market reversals, well, in years. I mean, for 4 really brutal years, this sector was just hammered. A bear market so bad that nearly half of all the public companies were trading below the cash on their books. The feeling was just, death, destruction, constant cash burn. But here we are, late 2025, and the whole story seems to have flipped. So our mission today is really to tackle that big question. Did we miss the turn? And if biotech is back, what exactly is driving this huge surge? What's changed?
Well, the recovery isn't just talk. It's definitely not just a blip. The numbers really support a genuine market shift. If you look at the key ETFs, like the SPDR, S&P, Biotech, XBI, it's up 25% year to date.
25%. Wow.
Yeah, and the iShares Biotechnology ETF, the IBB, that one's up nearly 19%. Both are just absolutely crushing the broader S&P 500's returns this year. So looking across all this information, our core conclusion really is that this turnaround is driven by, well, kind of a perfect storm of factors, macro and micro forces all lining up. And just to give you a sense of scale, the global biotech market was valued around $483 billion in 2024. The projection for 2025. $546 billion.
Just in 1 year.
In 1 year. That's a 13% jump, which shows really accelerating growth.
Okay. Let's unpack this. We have to start with the big one, the historical killer. Interest rates. Everyone remembers the collapse really started kicking off early 2021, right when the Fed got super aggressive with rate hikes. Biotech, I mean, it needs huge upfront R&D money, and the payoff, it's way down the road.
Yeah.
Years, sometimes decades. And that long timeline, that's what made those rate hikes so incredibly punitive, right?
Yeah.
Can you walk us through the mechanism there? Why do high rates just mathematically destroy the value?
Yeah, it's pretty straightforward, but brutal, like you said. When discount rates go up, the net present value of any cash you expect to get, say 10, 15 years out, it just plummets. It becomes almost worthless today. So the higher the rate, the more those future potential profits get penalized now. And when the cost of borrowing, the cost of capital skyrockets like that, well, those big R&D bets just don't look as good financially. And those pre-revenue companies, they become toxic for investors.
Right, makes sense.
But now those tailwinds are fully blowing. We had that key rate cut back in September 2025, and the market is pricing in more cuts. That drastically lowers the cost of capital. It gives these smaller cash-burning companies more runway, more breathing room. And critically, the big money institutional investors, they're finally comfortable owning these names again. They see a path forward.
And it's not just the Fed action stabilizing things, right?
Sure.
The sources point to shifts on the political and regulatory side, too, especially impacting M&A.
Oh, definitely. There's a strong signal, or at least an expectation, that the incoming administration will be, let's say, more permissive about consolidation in the industry.
And that expectation alone is enough to spark deals.
Absolutely. It seems to have fueled a real wave. The numbers show it. Just in Q3 of 2025, biopharma licensing deals hit $63.7 billion.
$63 billion in 1 quarter.
Yep. And year to date, that brings the total to $183.7 billion in announced licensing deals. That kind of volume is, well, pretty unprecedented. It tells you big pharma is aggressively looking to buy innovation and refill their pipelines. That pushes up valuations for the smaller targets. And there's another angle, too, sort of a defensive play adding stability. You're seeing major pharma companies announce these really substantial investments in U.S.-based manufacturing.
Managing supply chain risk. Tariffs.
Exactly. It's strategic. Manage potential tariff issues, shore up the supply chain, and that ultimately benefits their smaller biotech partners, too. It stabilizes the whole ecosystem.
Okay, this is where it gets really interesting for me, because I remember the pain, the psychological shift. Anyone following biotech from, say, 2022 through 2024 remembers that incredibly frustrating sell the news thing. A company would announce fantastic phase 3 results, like game-changing science, and the stock would just tank. It felt totally broken.
Oh, yeah. Demoralizing is the word. It felt like good news was bad news.
Exactly. But 2025 seems to have broken that pattern. Now, consistently, good clinical data seems to actually drive the stock price up, and it stays up. Why? Why are investors trusting the science again?
It really comes down to proof of concept, but not just for the science, for the business. Investors regain confidence because companies are finally showing they can translate that great science into actual profitable businesses. It's not just about the trial result anymore.
It's about successful commercialization.
Precisely. You look at companies like Madrigal Pharmaceuticals launching successfully into that fatty liver space, or Neurocrine Biosciences. Alnylam Pharmaceuticals. They've shown real revenue growth, real market execution. Those are the proof points. They validate the whole model, not just the molecule. That's why the confidence is back.
Okay, so that restored credibility feeds right into the valuation story. You mentioned biotech ETFs are crushing the S&P, but are they actually still cheap?
Well, yes, on a relative basis, especially when you factor in growth. It's quite remarkable. Let's look at the forward price to earnings ratio. Biotech as a sector is around 19.66 times forward earnings. The S&P 500 is a bit higher, 20.13x.
So slightly cheaper on forward PE.
Slightly cheaper, yes. But here's the kicker. The growth expectations. Projected earnings per share growth for biotech forecasted at 19.1%.
19% growth, oh.
And compare that to the S&P 500,
Yeah.
projected at only 6.88%.
Wow, that's a huge difference.
It's enormous, and that's why the PEG ratio, the price to earnings growth ratio, tells such a compelling story here.
Right, because it factors in that growth disparity.
Exactly. For biotech, the PEG is about 1.85x. For the broader market, it's 2.31x. Remember, a lower PEG is better. It means you're paying less for each unit of expected future growth.
So it strongly suggests the sector is maybe fundamentally undervalued relative to the earnings growth it's supposed to deliver.
That's the argument, yes. And the smart money seems to agree. Look at venture funding year to date. Biopharma VC funding is already at $17.1 billion. That signals renewed commitment from private equity and VCs. The deep pockets are back.
Okay, now let's get to the why. Why the M&A rush? Why the capital flood? It has to be the therapeutic opportunities, right? And we have to talk about the elephant in the room, the GLP-1 market. Obesity drugs. The scale is just mind-boggling. Projections hitting $100 billion by 2030. Some analysts even throwing out $150 billion by 2035. I mean, specifically the obesity drug part, going from maybe $8 billion this year to $65 billion by 2035. That's a 700% increase. But let's be real for a second. With numbers like that, isn't a lot of that hype already baked in? And how fast could that market just become commoditized?
That's a fair challenge, absolutely. And while GLP-1 is, the obvious headline grabber, the M&A isn't just about that. It's about diversifying portfolios. It's defensive. Look at precision oncology. That's projected to hit nearly $160 billion by 2029.
Huge market, too.
Huge. And the U.S. immunology market, over $130 billion projected by 2032. So big pharma, they're shopping across all these mega markets to find innovation. But what really lights a fire under M&A is the patent cliff. That's the urgency.
Right. The blockbusters losing exclusivity.
Exactly. There's a projected $300 billion in revenue at risk between now and 2030.
$300 billion.
Yeah, they have to buy new revenue streams to replace that loss. And these innovative biotech pipelines are basically the only place to find them.
And the pipeline seems pretty robust, keeping those M&A targets coming. The FDA seems to be keeping up its pace.
Yeah, the FDA approved 34 novel drugs through October 2025, which is a strong pace, keeps the innovation flowing. And we have some really crucial near-term catalysts, these binary events, coming up just next month, November 2025. Investors are watching these very closely.
Like what? Give us some examples.
Well, there's an FDA decision for Arrowhead's plozasiran that targets a rare, really devastating condition. Then you've got Otsuka and Bayer waiting on sibeprenlimab. That's a potential blockbuster antibody for kidney disease.
Okay.
And maybe a really big one, Kura Oncology's ziftomenib for acute myeloid leukemia, AML. This drug, if approved, could potentially treat about 30% of all AML cases where there just aren't any targeted therapies right now.
Wow, that's significant unmet need.
Huge. So these near-term events, they're like proof points that the sector's innovation engine is still generating these massive commercial opportunities right now.
And that innovation engine is getting a boost from AI, right? I saw the FDA even put out new draft guidance encouraging AI use, but that feels like just scratching the surface.
Oh, it absolutely is. The regulatory guidance is nice, it helps, but the real impact of AI is operational. Inside the companies. AI is, it's starting to revolutionize how they identify potential drug targets, how they optimize lead compounds. They can screen possibilities way faster than old methods.
Faster discovery.
Faster discovery, yes. But maybe even more importantly, AI has the potential to actually compress the development timelines and, crucially, reduce those historically high failure rates you see in phase 2 and phase 3 trials. If AI can better predict toxicity, better predict efficacy early on. Think about that.
Lower failure rates.
If you can lower the cost and shorten the timeline and increase the success rate for R&D, you dramatically improve the potential return on investment for every single drug candidate. That makes the whole sector fundamentally more attractive.
Okay, so we've built a pretty massive bull case here. You've got huge therapeutic opportunities, things like CRISPR and gene therapy really starting to move mainstream. You've got the capital environment normalizing, M&A providing a floor and an exit, and AI providing this operational boost.
Yeah.
But we have to be balanced. Let's transition to the necessary skepticism. What are the bears saying? What are the big risks here?
Well, the number one risk is just the inherent volatility. It hasn't gone away. Biotech investing is still heavily dependent on clinical trial outcomes. A phase 3 failure can still wipe out a huge chunk of a company's value overnight. That binary risk is just part of the game.
Can't avoid it entirely.
Can't avoid it. Then you have competition risk. We mentioned GLP-1s. There's always the threat of commoditization once a category gets proven and crowded. Regulatory and policy risk is always lurking, particularly around drug pricing debates. That could flare up again.
Right.
And financially, some companies did take on more debt during the leaner years, so you have to watch debt-to-equity ratios. If capital markets were to tighten unexpectedly again, that could be a problem for some. And, while the valuations look good on that PEG basis we discussed, in absolute terms, they're not dirt cheap. You still need conviction for a multi-year hold.
Okay, valid risks. So fundamentals look better, money's flowing, innovation's there. But what about the charts? Does the technical picture actually confirm this bull run is real, or could it just be noise?
No, the charts are definitely confirming the trend. It's pretty clear. Both the XBI and the IBB, those main ETFs, they're showing what you'd call textbook bullish price action. Strong upward momentum. They're consistently trading well above their 50-day moving averages. That typically indicates strong institutional buying and support.
Give us the specific numbers on that.
Sure, take the XBI. As of the latest data, it's up about 26.80% just since August 6th. It's trading around $109.21, which is roughly 7.6% above its 50-day moving average of $101.46.
Okay, so holding well above that key level.
Exactly. That kind of sustained uptrend, especially when it's supported by decent volume, confirms that this isn't just retail FOMO. It looks like institutional money finding positions and committing capital. So if we synthesize everything, the macro picture has clearly flipped. What was a major headwind, rising rates, is now becoming a tailwind. You've got falling rates helping valuations. You have clinical success actually getting rewarded again by investors who've regained confidence. Capital is flowing back in through VC and M&A. And the innovation pipeline is diverse and exciting: GLP-1s, oncology, gene therapy, you name it. And the valuation setup combined with that technical picture really does seem aligned for a potentially sustained recovery here.
Okay, so wrapping this up, what does this all mean for you, the listener, the learner? Well, the setup looks genuinely compelling if you have that multi-year time horizon we mentioned. And crucially, the tolerance for the volatility that just comes with this sector. You have to be able to stomach the swings. But for those interested in the growth potential that comes from, potentially life-changing science, it really does seem like the time for just waiting on the sidelines might be over for biotech. And here's a final provocative thought for you to chew on. We know oncology saw the biggest chunk of M&A deals, and we know about that massive $300 billion patent cliff coming. So thinking beyond the obvious GLP-1 space, which other therapeutic areas do you think are most likely to fuel the next big wave of acquisitions? Where will Big Pharma hunt next? See you on the next Pro Ticker Deep Dive.